Hello, thank you so much for joining me on Morning Markets. I love days like this. It is super busy. A lot of insight into companies that are probably in your portfolio. Microsoft and Alphabet among them. We're going to talk about those with our tech panel coming up. We're also going to get perspective on CN Rail, missing expectations, cutting its forecast, but the stock is holding in. We'll put that to Benjamin Nolan of Stifel, and grocery giant Loblaw beating expectations on both the top and the bottom line, but the stock is under pressure. Andrew Bell will tell us why. But first, this is all happening on a day where it is Fed Day. The Fed is expected to raise interest rates yet again come 2 p.m. Eastern time. That's fully baked into the cake. But of course, the question will be what happens next. Right now, the market is only pricing in about a 44% chance that we will get another rate hike. In other words, most think that we are done after this. After this, though, we are left with interest rates that are sitting at the highest since the beginning of the century, which is just a fun way of saying a little bit more than 20 years. Let's talk about this with Carl Tannenbaum, Executive Vice President and Chief Economist at Northern Trust, former Senior Vice President at the Chicago Fed. We've also got Derek Tang, economist and CEO of LH Meyer, monetary policy analytics, and an advisor to institutional investors on Fed policy. Gentlemen, it is great to speak with you. Derek, I'll kick things off with you. There's little probably with respect to the actual interest rate that will be, news to the market because it is so fully baked in. As always, the fireworks with the press conference. What are you expecting to hear?
Well, Powell will definitely try to keep all his options open for what's to come. And specifically, what he wants to push back against is a presumption that July is necessarily the last hike. He doesn't want markets to go away thinking July's the last hike. We're definitely sitting here at 5.4 until we start cutting. And he definitely doesn't want the market to think that the easing cycle is going to begin at the end of this year as opposed to sometime next year.
Carl, given what Derek said, don't you think that that kind of narrative is going to be perhaps a tough sell in an environment where the markets can see inflation is coming down and economic growth data remains robust? Is there a high chance that markets might be dismissive of any hawkish rhetoric?
That's the communication challenge that faces the Fed and other central banks as they get closer and closer to the end of their tightening cycles. Many central banks also have the added awkwardness of having paused and now having to go back to rate increases because inflation has proven more persistent. In the Fed's calculus, I think what they're going to see is that while we've had some very tentative and preliminary signs that inflation is on its way back towards target, they're not sufficiently durable to declare job done. There are components here in America of our consumer price basket on shelter and services that are still giving pause, and we are, after all, a long way from 2%. Financial conditions have improved tremendously since the spring banking crisis, and I think the message in the press conference later this afternoon is going to be that markets should be on guard for the possibility, as Derek highlighted, that this may not be the last move from the Fed.
Even with that, if we get, say, another 25 basis points at some point during the year, Derek, do you think we'll be in sufficiently restrictive territory with rates staying, call it at 5.25, plus balance sheet tightening that is taking place to kind of keep inflation in check?
Well, the scary answer is it's still probably too early to say. I mean, as Carl said, we're probably in the early throes of what could be a sustained disinflation trend. But really, I think the market and the Fed are on their toes waiting to see if it's actually going to become true. One of the things, as you mentioned, is, it's not just about how far they hike in this hiking cycle, but it's also how long they hold there and what the expectations of the easing cycle might look like. And so the Fed is very careful from here on out to communicate also that it doesn't expect a quick turn to easing. Of course, those easing expectations do weigh on how tight or loose financial conditions are right now. And if the market finds additional tightening uncredible because it's not backed up by data, then further hikes could prove to be counterproductive. So the Fed really has to play a balancing act here.
Derek, because you consult with institutional investors, do you feel like, given what we're seeing in the markets, equities are rallying, bonds are selling off, economically sensitive sectors are starting to advance, that the market is being too sanguine about the risk of, a recession, about, another roaring up of inflation? How do you think about that? How do you talk to your institutional investors about adequately pricing in that risk?
Well, certainly there are a lot of cross currents, not just from monetary policy, but also fiscal policy and geopolitics. I think one of the narrative shifts we've seen in the last month is, there's growing hope that maybe the Fed doesn't have to engineer a recession or even a lot of impairment in demand to moderate inflation. And that's providing a lot of hope to investors. At the same time, we've been through a very strange period since the pandemic, with an expansion that was really a bounce back from what was a fairly strong pre-COVID economy. And so a lot of things still have yet to settle, and we'll see how the structural shifts emerge.
Carl, what do you think about that? I mean, can't we just have a nice time? We've had this record increase in interest rates. Inflation is coming down. I mean, that's the direction. It might still be elevated, but it is coming down, and growth did not fall apart.
Well, the good news, to summarize, is that we persistently underestimated growth. A year ago, we had 2 consecutive quarters of decline in real GDP here in my country, and people were almost certain a recession would occur, and we've rebounded from that. But we've also persistently underestimated inflation, and there is hard business to do to get it down from its current level. Core inflation about 4.5% here, down towards 2%. I'm not sure it's going to take a recession. That's not in our forecast, but growth is going to have to slow from its current level in order to really take the pressure off demand and bring prices down durably. And I just want to reinforce something that Derek pointed out. A lot of what we're going to hear this afternoon is also going to involve how long the Fed is going to stay at the peak. My own view is that we are going to be in a higher for longer interest rate environment with no cuts until the middle of next year. And in that sense, yield curves, not just here, but certainly in Europe and then next week in the United Kingdom, are vulnerable to some reevaluation based on that message.
Is that because you don't think that the battle on inflation will be a straight line to 2%, that you must be pricing in or forecasting a rearing up of inflation?
Maybe not that, but I do anticipate inflation's going to take a little bit longer to work its way down. Inflation, as they say, is inertial. It takes a force to act on it, to really move it. If it gets embedded in wage demands, as we're seeing with some strikes around the world, it gets harder to get out of the system. And I think the Fed is going to want to be trebly sure, along with other central banks, that they haven't given away the hard-won gains on inflation of 40 years ago in the process of trying to ameliorate some economic challenges that may or may not arise.
Every time I bring up artificial intelligence as the productivity savior and the thing that could act on inflation, economists sometimes are dismissive and say, yeah, but that takes years. Ultimately, I mean, we have years. People always point to 1970s. That was a decade-long battle on inflation. If it does show up in 3-4 years, it still matters, right, to what monetary policy could look like. How much are you thinking, Carl, I'll start with you, about AI and how that could be the savior with respect to inflation and productivity?
I'm always grateful to talk about the longer term than just this afternoon's Fed decision. I think you've hit on something that's very important. There has been hyperbole at times about transformational technologies that would revolutionize the way that we do things and create productivity gains, but this one really seems to have some legs. And it comes at a great time because there's a demographic deficit in most developed countries that got worse because of the pandemic. So we're not going to have the labor force growth that we have had in past decades, and we're going to need to become more productive. For that reason, I think it's justified to spend not only a lot of time, but many companies are investing a lot of capital in trying to make the very most of this very interesting and exciting new technology.
Derek, I'll give you the last word on that.
Well, I think, it will take a few years to pan out. It does look like we're making a lot of progress on that front. But I'd say I'd take the devil's advocate view in that the adjustment costs might be quite painful for the U.S. labor force if the country is not well equipped for that transition.